Bloomberg says that this roaring economy cannot be slowed down. Read this headline. The United States economy surprised again in 2024 despite the Fed and election drama. What does that mean? Despite uncertainty about a presidential election, elevated interest rates, and a cooling labor market, economic growth remains solid. And that's why in this video, I want to go over why our economy boomed in 2024, and then I want to highlight some cracks that Bloomberg has identified in our economy as well. But let's go back in time just a little bit to January 2024. 12 months ago, the main headline in the financial news was that the economy will slow in 2024 and maybe we'll see a recession. Well, here we are in 2025, and turns out our economy actually grew faster than expected. And why did the economy grow so much? Because the American consumer is so strong. Or in plain English, Americans keep spending money, even if they don't have money to spend. The answer to why the economy exceeded expectations in 2024 is the American consumer. Even as hiring slowed, wage growth continued to outpace inflation, and household wealth reached new records, supporting an ongoing expansion in household spending. So even though we saw a slowdown in hiring, even though unemployment went up, Americans kept spending money. But this is where Bloomberg says we might have a problem. What are these cracks in the economy? Well, Americans are running out of money. Americans have mostly exhausted their pandemic savings and have generally been putting aside a smaller share of their incomes every month. Is it just me, or is it weird that we're still talking about pandemic savings in 2025? But what the article goes on to say is that we're seeing a divergence in how Americans keep spending money and why the spending is continuing so strongly in the United States. What it says is that wealthy people are able to spend more money because their asset prices have boomed. Stock values, real estate prices have boomed, so they're wealthier and they have more money to spend, which makes sense. Lower income people are not seeing that same gain, and incomes have not kept up with inflation, and so lower income Americans are spending more money through the help of credit card debt and other forms of credit, which is contributing to the economy, but they're running out of the ability to spend. Take a look. Between the 5 years of 2019 to 2024, we saw household income in America rise by 20%. Over the same time period, reported inflation was around 23%, which means that the prices of things have gone up faster than the average income. Along with that, credit card debt in America has gone up by around 26% because more people are having to turn to credit cards to fund their spending. Sorry for the not very straight arrow. And then we saw the stock market rise by more than 80% over those same 5 years, which means people that are investors got a windfall. They became wealthier. They were able to spend more money. And the average person is turning to the credit card, making the credit card company rich, which is also contributing to the strong spending. Now, this is where the question is what's going to happen in 2025, and this is why on January 7th, 2025, I'm also hosting a free wealth building workshop where I'm going to be going over how you can, number one, come up with an investing strategy in 2025, but also number two, how do you find unique investment opportunities in this changing economy? During a time where we have a new president coming in, during a time where we have all these concerns about changes in the economy, how do you find the unique investment opportunities and how do you actually research those opportunities? I'm going to be going over all of this on my workshop on January 7th. I'm doing it twice, once in the morning at 10:30 a.m. Eastern Standard Time, and then in the evening again at 8 p.m. Eastern Standard Time. It's completely free, but if you want to join, you do have to save your spot and register because we have a limited number of people that can actually join. So if you'd like to join me, I have the link for you to join on January 7th down in the description below. This is where that Bloomberg article goes on to talk about three different things. Number one, what's going on in the job market and the changes in the job market. Number two, inflation and how inflation hasn't been going down fast enough. And number three, changes in the housing market. And yes, if you want to read the article, I've also linked it for you down in the description. Starting with the changes in the job market, what we have seen is that hiring has come down while unemployment has gone up. Take a read. Hiring decelerated throughout the year and the unemployment rate edged higher, triggering a popular recession indicator. To quantify what that means, back in January of 2024, 12 months ago, we had an unemployment rate in the United States of 3.7%. As of today, at the time of recording this video, what we know is that the unemployment rate has jumped up to 4.2%. The reason why I wrote end is because we don't have the final December numbers yet at the time of recording this video. But when we do get that, we'll get the final unemployment numbers. But what this means is we have almost 1 million more unemployed people at the end of 2024 than we did at the beginning of 2024. And now the question is, what's going to come in 2025? And a lot of people are expecting unemployment to go up even more. And the reason why that's interesting is because the Federal Reserve Bank began cutting interest rates in 2024 to stimulate the job market specifically. But now we're starting to see concerns about inflation again. And so now the dilemma is, what's the Federal Reserve Bank going to do? Are they going to try to fix the inflation problem or try to stabilize the job market? Which brings me to part 2 of this article, which is inflation. Bloomberg highlights that the fight on inflation kind of took a pause, especially towards the end of 2024. Progress towards the central bank's 2% inflation target has stalled in recent months following a swift decline in 2023. What that means is after we saw inflation peak at around 9.1% in 2022, inflation fell pretty gradually. In 2022, the Federal Reserve Bank also began raising interest rates, and that began to cool down the inflation numbers. And in 2023, we saw a pretty steady fall of inflation. But then in 2024, we didn't continue seeing inflation fall. In fact, this is what people keep talking about as sticky inflation, meaning bringing inflation down from 3% to 2% is going to be difficult. And in fact, for the last few months of 2024, inflation didn't fall, but it kept rising month after month after month. Inflation went up. And this is where the Federal Reserve Bank is also saying that we might have a little bit of a tougher fight of bringing inflation down to the 2% level, which is what they're hoping for. Now, what I hinted at just a minute ago is the dilemma that the Federal Reserve Bank is going to face in 2025, which is, do they want to continue stimulating the job market? Or are they going to want to continue fighting inflation? Because what we saw in 2024 is, despite the concerns with inflation, the Federal Reserve Bank continued to try to stimulate the economy. But we don't really know what they're going to do in 2025. In fact, what the Fed has kind of hinted is that they don't want to be as aggressive with interest rate cuts in 2025. So we don't really know what they're going to do. Which also brings me now to what's going on with number 3 and the housing market, because as we know, mortgage rates play an impact in the housing market. Mortgage rates, which fell to a 2-year low in September, have been approaching 7% again on expectations that the Fed will take longer to cut interest rates. So you can start to see how everything starts to tie into one another. As mortgage rates are not coming down, in fact, they went up in 2024, the concern is that mortgage rates are not going to fall as aggressively in 2025, especially if the Federal Reserve Bank is not going to be as aggressive with cutting interest rates, which means if mortgage rates don't fall, housing might stay expensive. We might not see 4% mortgage rates anytime in the near future, which means if you're thinking about buying a house, well, now you have to really swallow the fact that you might be paying a 6 to 7 or maybe 7.5% mortgage rate, even if the Federal Reserve Bank cuts interest rates a couple times in 2024. That's one of the reasons why we've started to see more transactions happen in the housing market, because more people are starting to accept the fact that mortgage rates are not going to fall very drastically. But at the same time, we have a lot of people that own a house with a sub 5% mortgage rate, people that have a 4% mortgage rate, a 3% mortgage rate, or a 2.5% mortgage rate that's locked in. And now they're saying, I don't want to sell my house. I'm never going to sell my house. I don't want to go from a 3% mortgage to a 7% mortgage. That just doesn't make any sense, which is making it harder for people to buy a house because there's still not that many homes available for sale. However, the good news is we have more homes for sale now than what we did before, and we are starting to see more homes hit the market, so it looks like we will hopefully see more inventory on the housing market in 2025, which is good news if you're thinking about buying a house. But it doesn't look like we're going to see a big drop in mortgage rates. Maybe they'll come down to around 6%, depending on what happens with the government debt, what happens with treasury yields, what happens with the Federal Reserve Bank interest rates. But don't expect 4% mortgage rates anytime soon, unless something drastic happens, which never say never. We never really know what's going to happen in the markets. But this is where Bloomberg says that we have this uncertainty because obviously the housing market is a pivotal part of our economy and our economic system. But this is where they're starting to see some cracks, as they say, because people are spending more money that they don't have. We're seeing a rising debt level, especially amongst lower income Americans. And wealthy people are spending based off of the value of their assets. And if we start to see a slowdown in asset price growth, we could also see a slowdown in spending. And that could impact the economy because our economic system runs on spending. That's why it's important for you to understand what's happening, not to get caught up in the headlines, but so you can find the opportunities, because we know 2025 is going to be a crazy year. Of course, we'll be keeping you posted on this channel. and market briefs, which is my free financial newsletter. But then also on January 7th, I have my free workshop. So if you have not registered for that yet, I got that link for you down in the description. The stock market just took a nosedive because the Federal Reserve Bank just admitted that inflation is apparently still a problem, and you should ignore everything that Trump says and expect less interest rate cuts in 2025 because apparently inflation is still a problem. This is what Jerome Powell, who was the chairman at the Federal Reserve Bank, said.